Welcome to the Essential Tax Podcast with your host, Mishkin Santa. In each episode, we'll take the complex world of tax, all the jargon, acronyms, and stuff that make your eyes glaze over, and explain it in an impactful way to understand the complex and unknown areas. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcasts, Spotify, and on our website, thewolfgroup.com. Now, here's the host of Essential Tax Podcast, Mishkin Santa.
Hi, everybody. Welcome to the podcast. Today, we've got a heavy-hitting podcast about the upcoming changes in tax law in the U.S. I've got Russell Sullivan here with me today. Russell, will you tell our audience a little bit about yourself and kind of all your details so that they know who they're listening to?
Well, they're listening to a 63-year-old dad of 22 kids, none of whom are my biological children, but I have become their legal guardian when their parents die or otherwise incapacitated. And in order to support them, I work at a law firm named Brownstein. It's a Denver-based law firm, leading law firm in Colorado and a couple of other states in the West. But I'm in their Washington, D.C. office because, well, I worked on Capitol Hill for 20 years at the Senate Finance Committee, the late 1990s to all the 2000s and part of the 2000 teens, and was privileged to be on the staff that got to write the tax laws during that era. I worked for Bob Graham of Florida. I worked for Patrick Moynihan of New York, and for the longest period of time, Max Baucus of Montana.
Awesome. That's fantastic. So we've got the right person in the chair to talk about today's topic. I saw Russell speak at the CCH conference in October in Las Vegas, and I was just floored at how well he did kind of explaining, okay, this is what's going to happen in the elections. This is what's going to happen if the Democrats win. This is what's going to happen if the Republicans win. He kind of gave a couple different scenarios, and he talked about things that could happen, things that are promises, things that may happen. I thought it was fantastic. And unfortunately, I was not able to meet Russell in person at the conference because I had to speak right after him. And for anyone that attends the CCH conference, when you agree to be a speaker, you're speaking multiple times. I had to go for 2 hours, Russell, back-to-back on back-to-back days. So a much longer technical presentation than you had to do. But it's a very dedicated conference. I love the conference, fantastic conference. And I said to my managing partner, Jen Marenberg, who got to meet Russell, I said, we got to get him on the show. We got to get him to give our audience kind of his kind of insight and experience as to what he did when he was on the Senate Finance Committee, helping with those laws kind of move forward and kind of tell us what he thinks is going to happen next with TCJA sunset. So let's get right into it. I don't want to dilly-dally around the topic. So where are we at right now, Russell? How did we get here? Let's talk about where we're at and how we got here. Can you explain to our audience those two aspects?
Yeah, so we're here facing and on the precipice of 2025, which is a unique year because I can sit here and tell all your listeners, Mishkin, your taxes are going to change during 2025. It may be effective for 2025. It's for sure going to be effective for 2026. The business that you're associated with, whether you're the owner, you're an employee, you're a vendor, contractor, those taxes are going to change as well in 2025. And that's because of a confluence of two major factors. One, we have a new president, and every new president in his first term has to pass a bill that will change taxes in order to put his economic plan into effect. This has been true for 40 years, and it'll be true under Trump. He signaled it during the campaign, so we're going to do it. The second reason is because we have all the individual tax cuts from TCJA expiring at the end of 2025. And so if Congress fails to do something, then your taxes are going to go up and all of our listeners' taxes are going to go up. Well, politicians don't like to face mad constituents whose taxes have just been raised either by their quarterly estimate or by their January 20th paycheck for the first pay period of 2026 when their pay goes down. So that's why it's going to be a big year, and that's where we are.
Okay, and so let's talk about the Tax Cuts and Jobs Act of 2017. Can you walk us through, because I've heard a lot of stories about that process. I was told by people that the tax writing committees basically had a month to draw everything up. They basically looked at a bunch of different plans. They took, the House took one, the Senate took one, and then basically they introduced it on November 2nd. And then, kind of like I Dream of Genie, 6 weeks later, the bill was passed, and, it was a one-sided bill done through the reconciliation process. Can you just walk us through what happened there? To maybe explain what reconciliation is and kind of how that worked.
Sure. So 2016, we had a similar fact pattern in that we had a big election, a presidential election. Trump put out some campaign ideas during his campaign that year, but it wasn't written up with a big plan. It wasn't a 30-page document with details. He had concepts. The House Republicans under Paul Ryan had put out their own plan in the summer of 2016 without consulting Trump. It had a bunch of ideas. The Senate did not publish an idea, but they knew some things that they wanted to do. And it ended up that the Senate had all the leverage in 2017 because they had a very tight margin of control. And so they really couldn't lose any votes. They could lose like one vote. I think there were 51 Republicans, whereas the House had a lot more leeway to actually have Republicans vote no. So then what happened was during 2017, they made two decisions. One we can come back to if you're interested in. They decided to address healthcare reform and try to repeal Obamacare first. And they worked on TCJA, which just took them a long while, in part because of the focus on healthcare, and in part because they had three different plans to work from. And so it just took a long time to figure out what are our priorities, how much do we want to cut taxes, do we want to pay for any of it? The answer was no. And so that's kind of why it took so long.
And not a single Democrat voted for TCJA. So talk to me about how reconciliation works and what's that process look like so everyone can understand how a bill is passed under that.
So reconciliation is a process where the rules of Congress sort of reward a Congress if they put together a budget plan. We all know putting together a family budget, a business budget is essential. And Congress did that for themselves. If they can pass a budget which says, here's how much revenue we want to raise, here's how much we want to spend, then rules give them an advantage. And that advantage is that in the Senate, they can pass a bill with 51 votes, with a majority of one. Without that special rule, then the Senate rules for decades and decades have been that you have to have 60 votes to close off debate in the Senate. Well, Republicans back in 2017 and looking ahead in 2025, they're not going to have 60 votes. They're going to have 53 votes. And so that would mean that they would have to reach a deal with Democrats. That is very difficult to do since taxes have become an issue where the parties have very different priorities. And so Republicans have concluded, I think correctly, that they need to figure out a way. They need to meet the criteria of that reconciliation process so that they can pass a bill that can pass the House narrowly and probably pass the Senate narrowly as well.
Okay, and is there like a certain timeline in which the bill can? It's not like a forever bill, right? It has to be linked to a certain period of time. It has to pay for itself.
It's got to be linked to the budget. So you pass a budget. If you pass that budget, then that gives you actually three reconciliation bills. One's for revenues, one's for spending, and one's for debt limit. And you can use them all together in one bill, or you can separate them. So Congress has not passed a budget resolution for 2025 yet, even though we're 3 months into it. And the reason is obvious. The Republicans control the House, the Democrats control the Senate, and they couldn't reach agreement on how much they want to raise in taxes and how much they want to spend. So Republicans now coming in, it's still in that fiscal year. they can pass a budget resolution for 2025 and then do a reconciliation bill, which would extend tax cuts or whatever they want to do on the revenue side. Then come fiscal year 2026, which starts in October of 2025, they can actually do a second bill if they want to.
Okay. Now, based on your experience, how long does it take to write up, if we're looking at a TCJA extension update bill, right? How long does it take to write that up? What are things that you have to think about when you're on the tax writing committees that you have to factor into it? Can you just throw everything in the kitchen sink into it if you want to, or do you have to watch kind of what you're putting in, things that add to the budget or deficit, things that reduce it? Walk us through how that works.
Yeah, you can't throw the kitchen sink in. Every provision that's in the bill has to impact the budget. In other words, it's got to have a cost, or it's got to raise revenue, cut spending, increase spending, something that would affect the budget bottom line. And not only that, but the budgetary impact has to be significant. It has to be more than incidental to the policy objectives of the provision. So the example that I think folks can understand here is the Democrats, when they were in charge a couple of years ago, when Biden won in 2021, they wanted to raise the minimum wage in reconciliation. Well, raising the minimum wage would affect the budget because it's going to affect taxes. If people's wages go up, they're going to pay more income tax, they're going to pay more payroll tax. Companies are going to deduct that additional amount. So there would be ups and downs in terms of federal revenue. And the Congress scorekeepers acknowledged that. But they said, wait, but the revenue implication, that's not really why you're passing the bill. You're passing the bill in order to get people's employers to increase the wages of employees. And so the federal budget impact pales in comparison to that earnings or compensation purpose. And therefore, you can't put that in a reconciliation bill. Second, you can't touch Social Security in a reconciliation bill. So let's talk about Trump's proposal to exempt Social Security benefits from taxes. An idea that a lot of seniors would say, I like that. That's going to increase my take-home pay by 20%. Let's do that. But they're not going to get that in 2025 because if the House includes a provision exempting Social Security benefits, the Democrats will challenge it in the Senate, and the parliamentarian will rule that not only does that provision have to be stricken from the bill, it actually strikes the whole reconciliation bill and blows it up. And the Republicans would have lost their opportunity to pass a bill with 51 votes.
Okay, and so let's do a different scenario where you talk about military veterans, police officers having their income exempt. Could you also make their wages exempt from Social Security, or is that also the same principle where that's a no-fly zone?
That's a great question, and the answer is not clear. So I think there certainly have been times where provisions were included in reconciliation that impact people's payroll taxes and their income taxes. For example, in 2001, we had a bipartisan reconciliation bill under George W. Bush, and provisions were allowed to expand the amount that people could contribute to retirement accounts. Again, the same principle applied. If you contribute to your retirement account, that amount is, if it's a 401k and not a Roth IRA, you get to exclude those amounts from your compensation for calculating your income tax. And so it affects revenue. And even though there's a collateral effect on your payroll taxes, it's not disqualified. In other words, they allowed provisions that would have some impact on Social Security, but not nearly as direct as saying we're going to eliminate taxation on Social Security benefits. So the Republicans, if they wanted to do that provision, or the same in the context of the TIP proposal, they'll craft some provisions. They'll go to the Senate parliamentarian and say, would this pass muster? And she will decide whether it will or not. In that case, I predict what will happen is the Republicans will craft a provision on the tip income, but they'll do it the safe version. They'll say your tip income is excluded from income taxation, but it's not excluded from payroll taxes. In other words, you're still going to have to pay your payroll taxes on your tip income, but you don't have to pay income taxes on it. And that will, I would say, pretty safe bet that that's not going to run afoul of these rules that say you can't touch Social Security.
Okay. And just one small follow-up question to the exemption of tip income or income tax, federal income tax on police officers, firefighters, veterans, and active military. I just for our listeners to understand, the law that would be passed is a federal law. So the states would then have to decide if they're going to conform to that. So, for example, you could have income tax eliminated on tips. Maybe Social Security is still there. But say the state, obviously Nevada doesn't have a state income tax, but let's just say another state, we could come in and say, well, we're still going to tax that income tax because the federal law we're not conforming to that. Is that correct? This wouldn't, just wholeheartedly eliminate all income taxes on income.
You got it exactly right, Michigan. And some states automatically follow the federal law. They say we're going to define gross income or adjusted gross income for state purposes the same that federal defines it, unless we pass a separate piece of legislation changing it. More and more states have said, I think we'll develop our own definition of income for state tax purposes. And then they may very well pass a bill that mimics the federal, or they might not. We see this in the student loan forgiveness debate right now. At federal level, Biden has been trying to forgive that debt and not count it for income tax purposes, but some states do. Some states don't.
So once this law gets passed, whenever that is, and we'll talk about the time, your thoughts on the timeline here in a little bit. But then the next shoe to drop is, what do the states do as far as conformity? How do they define it? Will they do add backs? Will they define it differently? I think that's something that a lot of people don't even think about when they see a new tax bill come in. And we saw that after TCJA. There's a lot of issues with, and there's still ongoing issues with conformity, especially in the international tax realm where I specifically practice. We're always having to look up to see what's the current status of conformity to GILTI and some of the other provisions there.
Well, not only that, but your big example would be SALT, where a lot of the states did not like that SALT cap, and so they actually came in and legislated to try to not only deal with their state issues, but to deal with the federal law and try to use state law to get around it.
Yeah, so let's talk about that for 2 seconds since you brought it up. So SALT stands for state and local tax deduction. Prior to the TCJA, you could deduct your state income taxes, property taxes. There's a whole slew of things you could deduct. And then there's a cap that came in with the TCJA of $10,000. What do you foresee in that realm? Are there certain Republicans that maybe on the East Coast or West Coast that are going to be stuck on, hey, we at least got to get that up to 20,000 or eliminate that altogether to get my vote? Where do we see that going to?
Yeah, I think here 2017 is instructive. So in 2017, we had in the House of Representatives, they eliminated the deduction totally. There was not even 10,000 that people could claim. In the Senate, however, Susan Collins of Maine, which is not a tax-free state, they have an income tax in Maine. She said, I'm not doing this. We're going to at least exempt low-income people. They're going to get to claim their state and local taxes as a deduction. So I'm going to insist on at least a $10,000 cap. Well, again, in 2017, the Senate had the leverage. The bill that was ultimately signed into law didn't look like the Trump campaign plan, didn't look like the House bill. It looked a lot like the Senate bill. This time, the roles are going to be reversed. The Senate's not going to have quite as much leverage. They're going to be able to say to Susan Collins or somebody else, if you don't like this, you can vote no. We've got 52 other votes. We've got 51 other votes. We got 50 votes, and we got the vice president who'll break the tie. The challenge will be in the House of Representatives, where it looks like for at least 4 months here, it's going to be 217 to 215. Which in the House is a very narrow margin, probably the closest margin we've had in half a century and maybe longer. And so a group of 4 or 5 Republicans from states where the cap matters a lot, if they band together and say, we have to have at least a $20,000 cap, we have to have at least a $25,000 cap, we have to have a cap, and you got to have no marriage penalty. So a married couple gets twice as much as the other. If they stick to that and articulate that and hold to that, that's what will be in the bill at the end, because they will have to have those 4 or 5 votes in order to pass the bill. And I don't want to get too political, but Michigan, if you look back over the last several Congresses since TCJA passed, you had different times where Republicans were in charge. They said they were going to modify the SALT cap. They didn't do it. And a lot of their members lost in those states. You had other elections where the Democrats came in and said, the Republicans passed that SALT cap, we'll get rid of it. Watch us. And then they passed the Inflation Reduction Act, and it didn't deal with the SALT cap. And then they lost their races. I think the politicians that are smart are going to want to be the ones who actually insist on it. And I think Trump's given them an out here, because he went out in the campaign toward the end in New York and said, I don't really like the SALT cap the way it is either. So I think we're going to see a compromise there, and it'll probably be the biggest change of any provision of TCJA compared to current law.
Well, I personally like that, because the SALT cap I know hurts my taxes. So I'd be super interested for any single raise that occurs there. And that's an interesting insight. Okay, let's talk about where we're at today. So who are the main players in the game for the Senate, the House? I think that the Republicans in the House named 4 committee writers to their tax writing panel. I think that was just yesterday from Ohio, Florida, Texas, Indiana. What's happening? What are they doing right now? Who are the big players? What are we seeing as kind of the next steps there?
Yeah, so there's 2 ways to look at this. There are people who have the pen and will be leading the effort, and that's Jason Smith, who will be the chair of the Ways and Means Committee, Republican of Missouri, and he's already demonstrated his skills as a leader. He's both gotten every bill that he wanted to pass through the Ways and Means Committee has passed without much consternation from his caucus. And not only that, but he's been able to negotiate a bill with the Senate with Ron Wyden, a Democrat, on a bill that was bipartisan. Now he'll get to test negotiating with Mike Crapo, who's the chair of the Senate Finance Committee from Idaho. You also got the leaders, Speaker Johnson, Mr. Scalise, who's second in line in the leadership. I think Mr. Scalise has taken a significant role in tax issues thus far, but you should also know that Speaker Johnson actually hired Jason Smith, Chief Tax Counsel, to come to his office. So there's lots of coordination between those offices. However, I want to go back to the point is that everyone who's willing to use their leverage will have power in this process, with the House so close in terms of its balance of power between Democrats and Republicans. And they need only look to a couple of years ago when Joe Manchin and Kyrsten Sinema in the Senate foiled the Democrats' big plans for a $4 trillion Build Back Better bill and scaled it back to a $600 billion Inflation Reduction Act. That's because they were willing to vote no. Will Republicans in the House be willing to vote no on this bill? If they're not willing to vote no, then they're not going to have as much leverage. But if they're willing to stand up and fight for a principle or a provision to be included or excluded, they can have a lot of power.
Okay, and then one person you didn't mention is John Thune, which is the Senate Majority Leader. I know that he has introduced the Death Tax Repeal Act a couple different times over the last couple of years. How big of a role do you think he'll play? And do you see maybe the estate tax going away as part of this bill, or is that something that's too taboo?
So John Thune's role will be critical in a number of ways, and he's just the guy to lead the Senate to make it happen. First of all, he is respected and well-liked by everyone that I've ever talked to in Washington, D.C. Be you a very conservative Republican, moderate Republican, or even Democrat. He gets along with Trump, and he will bridge the gap between Trump and the Congress. He gets along with Speaker Johnson. He has been serving on the Finance Committee. He wrote significant aspects of TCJA, not just the estate tax provision, but most of the provisions that deal with pass-through businesses, the 199 Cap A 20% deduction, which makes the effective rate closer to the corporate rate for pass-through businesses, and a wide variety of other provisions, including some of the international provisions. So he is the right guy to actually help put all this together this year. I don't think the estate tax will be repealed. Full disclosure, I work for a coalition of family-owned businesses that would like to see that happen. But, we're in a situation where, you've got a TCJ that already costs $4.6 trillion net, and repealing estate tax would cost more. So I think there'll be something short of that, but I think we'll see the exemption amount hopefully stay on track for its current level of near 14 million a person.
Okay, so you don't foresee that going up to say 16 or 18 million, just kind of staying par to where it is right now with inflation?
Well, no, Mishkin, I think if they just change the dates and extend the provisions of TCJ, it will continue to increase with inflation over a period of years. So during the next 10 years, it certainly would go up to 16 or 18. And they don't have to change that provision in order to make that happen.
I see. Okay, great. All right, so now that we know the players in the game, we kind of know what's going on. Sounds like that they're getting the tax writing committees, the steering committees, they're all getting in place. Where do we see the timeline here? Because President Trump has said, look, I want to get this done in the first 100 days. He's talked, my understanding, about a full extension of TCJA. It sounds like the House kind of wants that to go too, whereas the Republicans in the Senate are like, whoa, maybe we do a smaller bill at the beginning and then we maybe tackle TCJA Q2, Q3. Kind of tell me what's going on there and what can we really expect to happen as far as when we can see something that really moves?
So, first of all, I'm not a betting guy, Mishkin, but if I were, I'd bet a lot of money that they're not going to get it done in the first 100 days. Now, they're going to get it done. They're going to get it done like the Kansas City Chiefs get it done, okay? The Chiefs may be behind by 2 touchdowns in the second half.
They still get it done.
They're going to block the field goal, or they're going to score in the last minute. They're going to win. A
win is a win.
They have to pass the bill. They have to get it done. They have to get it done by the end of 2025. They don't have to get it done by the first 100 days of the Q1. They may very well try, but I've lived through a number of these. 2001, we had a very simple bill. George Bush's tax cuts were $1.35 trillion. Not that complicated, mostly rate changes. And it took us 5 months to get it done. We had the Affordable Care Act. It took 1 year and 3 months to get it done. We had the Build Back Better the Democrats tried. It took them 1 year and 6 months. 2017, it took them a full year, 12 months to pass that. Now, that was a much more complicated bill with a lot of corporate international complicated provisions that they had to modify as they went through the process, as they learned the impact from stakeholders and businesses and individuals who educated them. But they're not going to get it done because they've got a big challenge in figuring out where they are. They have to get unified on the budget. They have to decide, are we going to pay for this or not? Are we going to pay for all of it? What can we pay for it with? And they have lots of choices, and they haven't made much progress on that in a month or 6 weeks since the election. It will take them into January at least to figure that out. Then they have to actually craft those provisions. If they actually are going to include offsets, that's going to take extra time as well. Third, they've got all these provisions that Trump proposed that are outside of TCJA. The TCJA ones could be fairly simple. Changing the SALT cap from 10,000 to 25,000 is not complicated. Once people agree on it, they can craft that legislation and move it quickly. But Trump has 5 provisions, new provisions that relate to workers. He was very effective in saying, I want to help working Americans. And so he had the proposals on tip income, overtime income, military pay, responder pay, citizens working abroad, and Social Security. Some of those, one or more of those, is going to get in. So they have to add that. He had business provisions that he also included. He's got a manufacturing rate of 15%. That's a complicated provision, but is really kind of almost necessary to sort of balance out his proposal on tariffs, which is going to increase the prices of good and the cost of manufacturing in the U.S. A tax cut on manufacturing would sort of help offset that. And so I think there's going to be a lot of interest in doing that kind of provision, but that'll be complicated as well. That's why it's going to take him more than 100 days.
Okay, let's talk about two things that you mentioned there. First off, tell me about the tariffs, because I don't think a lot of people understand how tariffs work. I don't think a lot of people understand that what Trump did in his first term with tariffs. What can we expect with tariffs? What do you think is going to happen there? And then can that revenue be used to offset some of the stuff in these tax bills? There was talk about a sovereign wealth fund, whatever that is. Talk to me about how that will work.
First of all, folks should know that tariffs are taxes from an economic perspective. It's collecting revenue on a transaction, on the movement of goods from outside the U.S. to the U.S. And change of hands of ownership. It's very similar to our excise taxes on gasoline and cigarettes and fishing equipment and a wide variety of excise taxes we have in the federal tax code. And we import over $2 trillion worth of goods each year. It's $2 trillion.
Wow.
Mostly from Mexico, Canada, and China, a majority of that, but really from countries all over the world. So if you took what the most conservative provision that Trump talked about, a 10% tariff on all imported goods, that would be $200 billion per year in tariff revenue. And if you add 200 trillion over 10 years, the life of this bill that they're looking at, that's $2 trillion. That's paying for half of the cost of extending the tax cuts. Now, I'm not saying that Republicans want to use tariffs to pay for it. Let's take China. He's proposed 60% tariffs on China. We import from China $500 billion worth of goods a year. That's another almost $2 trillion just from China alone.
Wow.
And then now he's proposed a 25% tariffs on Canada and Mexico, the other countries where we have nearly $500 billion in imports per year. So you can see how if he did a comprehensive proposal on tariffs of all of his proposals, he could fully pay for the tax cuts. That's not going to happen. That's too many tariffs for the barge to not sink. In other words, you wouldn't get all the votes you needed to pass it. So the other unique thing about tariffs is Trump doesn't have to get Congress to approve the tariffs. He can impose those on his own. And I think that's likely to be what happens, because you've got some Republicans that are still for free trade. They haven't sort of come around on his view on tariffs. So Trump will have to go through a process to impose the tariffs. And I'm not sure he's really wanting to impose the tariff long term. We can look at his comments on Canada and Mexico recently, seem to tie the tariff to their cooperation with the U.S. over immigration reform and blocking people from coming across the border who don't have a legal status in the U.S., and also in trying to fight the drug trade, fentanyl in particular. And it sounds like if they cut a deal to work together on the border issues, that Trump might say, okay, I won't impose those tariffs on Canada and Mexico. So it's probably going to be a lot less than $2 trillion that we raise in tariffs over the next 10 years, but they could be significant.
Okay, and so just to connect the dots, let's just say that he unilaterally imposes tariffs at certain rates on China, Canada, or Mexico. When that revenue comes in, how does that get redirected to the tax bills when they're writing those? Is there Is that just something that they can dip into and say, we're going to use that revenue? What was this talk about a sovereign wealth fund? Is that something that you think is kind of not going to happen now? Or how does that, how do the dots work there?
So there's two ways that they could get credit for the tariffs in the context of writing this tax bill. One, Congress could actually raise the tariffs by statute. That is unlikely to happen in significant amount. I could see some tariffs on China passing and all Republicans supporting that. I think a lot of Democrats would vote for that particular provision as well. But broadly across the globe, I don't think that's likely to happen. I think they're going to let Trump take the heat for imposing the tariffs. They can do some things in the budget resolution and in the reconciliation process and in the court of public affairs to say, hey, we are actually going to raise $1 trillion, $2 trillion, whatever the amount is in tariffs over the next 10 years. And that's real money going into the Treasury. We should get credit for that. It might not legally meet all the rules in the reconciliation, but they could say in the reconciliation, we assume a baseline where we're going to collect an additional $1 trillion worth of tariffs. Okay, then they don't have to put a provision in the bill imposing the tariffs. They just assume that. And then they could, in the media and in Trump's messaging this to the American people, he could say, we're raising tariffs. We are paying for it. And you know what? I think most Americans would believe that that's true because economically it is true. Now, you have to factor in the fact that other countries are going to retaliate against us. We may get skittish about it. New money.
Okay, and I think you talked about a provision in the Internal Revenue Code that he might allow corporations to use. Was that the 897 provision, I believe?
Yeah. The tax code right now does allow the president to double the corporate tax rate on companies from countries who are operating in the U.S., but in their own country, say France or Germany, that they have imposed taxes on U.S. companies that are really not the profits of the subsidiary operating in France or Germany, but are really the profits of the U.S. company. And so it's possible we could have a sort of a trade war through the international tax code that Trump could do that. And Jason Smith has proposed some enhancements to that language, which would make it easier for the president to do more that way. So we could see the evolution of that as a means of discouraging other people from taxing U.S. companies. I would note just yesterday, just this week, Trump talked about, and his folks talked about, hey, in trade, we're going to do reciprocity. If other people are imposing tariffs on U.S. goods coming into their country, we're going to impose tariffs on their goods being exported to the U.S. And I think we could see that principle play out in the international tax space too. They start taxing U.S. companies more in accordance with the OECD global minimum tax and the UTPR, and we're going to tax them as well, not under those provisions, but under our own provisions.
Gotcha. Well, it sounds like I need to read up on 897 and get really familiar with that one. Tell me real quick about so you mentioned the 15% manufacturing rate. That relates to C corporations, and C corporations right now have a flat rate of 21%, which is forever, right? There's no expiration on the 21% corporate tax rate. I believe some Republicans have said that tax rate is not sacrosanct, meaning that they could foresee potentially raising that rate maybe to meet the requirements of OECD Pillar 2. So maybe that goes up to 24% or some kind of combination. What do you see happening there, and how palatable do you see the 15% manufacturing rate being as far as something occurring?
So there were some congressional Republicans who refused to take a pledge to say, I'm going to keep the rate at 21% or make it lower. And that's because they wanted flexibility to be able to, as I said, they want to They want to be able to be the Chiefs. They want to make sure they get the bill across the finish line into the end zone and make it work. And so they didn't want to, limit themselves. But they were expecting, some of them expecting a situation where the Democrats might have controlled one of the chambers, probably the House, which they got very close to doing, but didn't quite make it. So now, though, that it's Republican control, I don't think we're going to see a increase in the 21%. I think this 15% rate on domestic manufacturing has not received as much attention as it should have in enterprises throughout the country, because I think that Trump, one, he's going to win on this issue. Number two, he's going to need a carrot to offset the stick of the adverse impact of the tariffs. Now, he claims there aren't any adverse impacts of the tariffs on U.S. manufacturers, and importers. But I think most people would say there are going to be some inflationary impacts there. This tax reduction could further accelerate companies making decisions to manufacture in the U.S. rather than abroad. And Mishkin, I'm not sure it's necessarily going to be limited to corporations. He's kind of talked about that concept, but he's also used the word deduction rather than rate at least once. And the deduction sort of harkens back to the old Section 199, which was a manufacturing deduction that effectively reduced the effective corporate business rate or corporate rate to about 3 percentage points. So we could see a merger between the current 199 Cap A and the old 199A if Trump is successful on the rate, or we could see him just change the corporate rate in the code. Either way, he's going to have to define manufacturing, and he's going to have to define what is domestic, because both of those are going to be critical to companies figuring out, well, am I in it or am I out of it? Does crafting software count as production? Does producing electricity, is that manufacturing or not? And then to be domestic, do I have to be 90% domestic feedstocks or 100%, or is it tied to some other kind of rule? So those are answers that we don't know yet, and unless it picks up some steam, which I think it might, we may not see a lot of that for a while. But if it does get some momentum, then we're going to have debates over those issues.
Okay, one more business question, and then I want to do some quick hits on the individual tax proposals, and then we'll call it a day here. So 199 Cap A, you just mentioned that, the Qualified Business Income Deduction. Talk to me about that, because that expires at the end of this year. That's one of the items that expires in TCJA. What's the likelihood that's, like you said, John Thune, he fought for that. That wasn't part of my understanding. That wasn't part of the House bill in 2017. What happens there? Does that stay in? Does that get modified? Does it go out? What's your thoughts there?
Well, I think it's going to stay in, and we at Brownstein have formed a coalition to make sure to advocate for its extension in its current form at minimum. But I think it has a significant amount of popularity. Senator Marsha Blackburn has already stepped up and is starting to work on that issue and says it's one of her top priorities. She's from Tennessee. And so I think we're going to see that, but it is an expensive provision. Extending it will cost $700 billion in its current state. But I think it is critical to sort of making sure that the tax code is not driving decisions about structuring a business entities. If it's not extended and the corporate rate stays low, then I can assure you a lot of the 25 million taxpayers who are structured as pass-throughs are going to switch to C Corp status to get that lower 21% rate. And so I think there'll be a lot of pressure to do something there, but there could be modifications to that provision, at the margins.
Yeah, I mean, I can tell you that those conversations in real life are already happening. I mean, internally at our company, we're an S Corp. We've talked about what happens if 199 Cap A goes away. Do we convert to a C Corp? I know that a lot of our clients that are also S Corps have asked the question. So that's a real life consideration that a lot of people are talking about right now. Let's do some quick hits on some of the individual tax proposals. Tell me what you think. We'll we don't have to talk a whole lot about them if you don't want to, but just do you think that there's a reality of them coming in or not? So let's talk about the first one, which I think was just recent. Do we think that the capital gains tax rates are going to change, get reduced in any way, shape, or form?
Well, the TCJA provision did not change the rate numbers, but it did expand the brackets at the lower end. I think that is safe. They're not going to go back to the pre-TCJA version. That was not one of the most expensive provisions in TCJA. But I will note that this week, President Trump did say, oh, maybe it's over the weekend, well, I really want to go back and look at dividends and capital gains. Maybe we need to do some cuts there. This is sort of, like the issue that we all face around the holidays, Mishkin. So there are some things like going to grandma's house for Christmas or some holiday where you really want it to be just like it was every year before. You love the gravy that she makes. You love that 4-layer chocolate pie that your aunt makes. You love that broccoli and cauliflower casserole that you hate broccoli and cauliflower, but somehow it tastes good at that meal because they put a lot of butter and cheese in it or something. But this is not that. Trump and some Republicans say, oh, if we just extend TCJA, we're not changing the economy. We're not changing the incentive. We're just extending what we already have. That's not a tax cut. That's just status. That's not enough. We want something else on the menu. This is more like going out to eat and you want a new entree that's delectable and that really stirs your taste buds. That's what Trump wants. And that's why he's put out all these new proposals on the individual and the business side, because he really wants something that's going to drive further growth in our economy and help workers who are struggling with high cost. And so I think we're going to see some of those.
Okay, let's talk about one of those new ones, one of the new potential menu items. Automobile loan interest. And I don't think they've said whether it's an above the line deduction or an itemized deduction, but what do we feel there?
Someone on the campaign staff said it was for itemizers, which means it's limited to 5-10% of Americans who purchase a vehicle and debt finance it. I don't think this one is at the top of the list, Michigan. We haven't heard much discussion of it other than when he announced it in Michigan. He did win Michigan, but I'm not sure there's a groundswell for going to put this provision in.
Okay. What about bringing back the first-time home buyer tax credit?
That's a fascinating one. And in a time of limited housing, we have real estate needs both on the individual and the commercial side. So I think that potentially has some viability. A lot of people didn't like the previous one that we had. I believe that was an $8,000 tax credit or some amount a decade ago. But the people who got it liked it. So I think they're going to have to do something in the housing space, and a lot of Republicans want to. So that seems to be a potential leading candidate.
All right. What about repealing the Inflation Reduction Act energy credits?
They're not going to repeal the credits, Michigan. They're going to find out this is just like Obamacare. You can't give people things and then take it away. People have acted on those IRA energy tax credits. They're going to be able to change them. The EV credit is the most vulnerable. It has the highest risk. I don't know of any Republicans who are saying I'll, vote against a tax bill if it includes repeal of the electric vehicle tax credits. But all the other ones I think have champions. They'll work around the edges. They'll limit China's ability to claim those with Chinese companies, even if they're private sector entities. But other than that, I think structurally, generally, they're going to be safe. Now, they will eliminate a lot of the IRA spending programs, the loans and the grants that were available. I think they could probably save $100-200 billion there by just, stopping on January 20th, letting the cash go out the door. Those programs have some discretionary features, and they can certainly at least delay it, if not end it.
So I was at an IRS conference last week. George Washington University and the IRS always put on a fantastic international tax conference. And it was a common theme I heard a lot of, because the IRS sends a lot of international folks, from their different divisions to speak there, along with private practitioners. And what was fascinating, it kind of uniformly was, they're all working on proposed regulations or something along those lines. And the question was, when do we think the final regulations will come out? And there's this kind of underlying theme, like, well, it depends if we get our funding or we don't get our funding. They know that their funding is potentially subject to being stopped. Do we see the IRS funding they got under the Inflation Reduction Act maybe being cut off or reduced significantly?
So there are two things that Trump can do. One is he can direct the Department of Energy to we're going to have a temporary freeze on all the grants and the loans. Could say the same on the tax credits. He says, I want to review the regulations. I want to make sure that Treasury and Department of Education are complying with the laws that passed. And then I'll let you know in 3 months or 6 months, sort of where we're headed. And if he chooses to propose new regulations, he can do that. But he can also slow walk the spending, Mishkin. I hate to admit it, but I think all administrations, Democrat or Republican at times, have said, well, we're not saying no, but we're not saying yes. So give us more information on your project
before we give you more money.
Yeah, we got you tentative approval, but we haven't signed the fine. We haven't closed the loan and given you the funds. And in those cases, we may see a significant delay, and then possibly Congress could cut off the funding and say anything that's not out the door by the date we enact this bill, we're eliminating those funds. Congress has done that with unused CARES Act funds and others during the pandemic and previously during the recession in the late 2000s.
Okay, final question here, and it's an international question because a lot of the audience that I have have international related matters. How do we feel about promises made to the Americans abroad, the end of double taxation for Americans abroad, potential changes to FATCA? Do we see any of that? Somewhat, is there like a slice that might become a reality? Some kind of percentage you want to give to that, or is that just too big of an issue to tackle? That to me, that's like eating the elephant. That'd be a very tough one to try to craft. They put a lot of that into the TCJA when they kind of changed everything on the corporate side there and introduced GILTI and the transition tax. Do they have the stomach for another go around, perhaps for individuals, or do we just not see that being a reality this time around?
Well, I think this is a challenging provision. Certainly, if a U.S. Domiciled individual working for a U.S. company goes abroad and takes a tour to learn about their European or their Asian facilities or whatever, we all know that there's cost to that. That costs a lot of money in terms of housing and setting up shop in a foreign country and travel back to the U.S. on a regular basis. So that's why we have that Section 911 exemption of part of your earnings that you have abroad. So I think it's not clear exactly what Trump is saying, whether he's saying full exclusion or let's modify that provision. But certainly, I think there's some sympathy for the American workers, but there also has to be some sort of parity between what are the benefits we're giving people who work overseas versus the benefits we're giving to the workers here in the U.S. And so I think they'll have to kind of work that out to make sure they're not giving too much benefit to U.S. citizens working abroad.
I see. Okay. Well, very, very well done. Very insightful. Thank you so much for all of your insight and everything that you brought to the table today. I found the conversation stimulating and fascinating. Any parting words that you want to leave to our audience?
Go Chiefs. Let's
Go
do
Chiefs.
Get a three-peat. I grew up in Arkansas, so I root for the Chiefs.
Okay.
And I appreciate the opportunity. Look forward to talking to you again at the appropriate time.
All right, Russell. Appreciate it as well. Thank you so much for being on.
You've been tuning in to the Essential Tax Podcast with your host, Mishkin Santa. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcast, Spotify, and on our website, thewolfgroup.com. Thank you for your positive reviews, comments, questions, and for sharing this show with others.